Stock markets beginning to tumble as debt ceiling negotiations further apart than ever. Welcome to another Insights brought to you by Ainslie Bullion and the Gold and Silver Standard. Today we are talking about US equity markets and how they're finally facing the reality that the T-bill market has been preaching for the past 2 months, that this debt ceiling, this crisis is not going to go away anytime soon. And we have regular contributor Branko joining us today. G'day Branko, and welcome back.
Thanks for having me. Glad to be back. Glad to dive into today's topic yet again.
No problem. Now, let's start with the first one. How are the markets responding to the debt ceiling crisis, and what's changed over the last week, in your opinion?
Yeah, so it's something we've been following for a couple of weeks now. I think it's really dominating the news cycle and is the key discussion point for the financial markets and particularly for gold, especially in the event of a US default. That would obviously be huge for gold and silver. But in terms of what's happened the past week, so, last week we previously had the market sort of in denial, right? The Treasury bills were the leading indicator of the dangers that could happen and kind of displayed the negativity and a lot of downside risk. And this week, specifically yesterday, in light of Ted Cruz, Senator, who came out and said that, there is a significant risk of a deal kind of not coming, and there is a risk that a deal might not be reached. And then he also said that, given Biden and the incompetence of some of the staff, that it's going to be difficult. So the markets responded quite negatively. And, we saw the Dow Jones went down by over 1%, S&P went down by over 1%, and the NASDAQ had its worst day in over a month. So equity markets are starting to see what the Treasury bill markets have seen for a while, which we've discussed in the past. So that's kind of what's changed as of the past week.
Okay. Now, in terms of this apparent new date, the X date, as they're calling it, what is this apparent new X date, and what's the actual debate over it?
Yeah, so Janet Yellen kind of wrote a letter to Congress saying that the date was June 1st. And a quick refresher, the X date refers to when the US basically runs out of money. And there is a bit of a debate around the specific time at which it's going to occur. So some Goldman Sachs analysts are currently saying between 7th and 8th of June. And Janet Yellen is saying the 1st. So there was a bit more market panic when she said it was the 1st, because that was previously closer than expected. So that's also what's caused this more dramatic effect in the financial markets, is that date is a lot earlier than we originally thought, according to Yellen.
Yep. Okay. So I guess the big question is, why are people flocking to the safe haven assets in this particular time, given the debt ceiling crisis looming?
Yeah, so Yellen also said that she expects investors to continue to flock to safe haven. And the reason is, as we discussed, is that in the event of a US default, basically there was a poll that came out we discussed last week that over 50% of investors said they would invest in gold if the US were to default. And it is by far the safest asset, in that event. Obviously, shares would continue to spike. Obviously any asset that is risk on would be, significantly probably, see some decrease in terms of price fluctuations. So people are flocking to these safe haven assets, and gold's probably at the top of the leaderboard, especially given the technicals. And, it's obviously been doing very well the past, basically been doing well all year. People are flocking to it, and I think it's something to watch. If you do hold gold, the risk reward is extremely high right now in your favor. Just because, like I said, in the chance of a US default, expect gold to just do very well.
Absolutely agreed. Gold does tend to do well in potential crises, and then if an actual crisis does occur. Now, I guess, what do you think is the actual chance of a US debt default? Because we've seen them, almost happening for over 70 something times now, and they always kick the can down the road. What do you think this new chance is, and what do you think this means for people at home?
So I think if you asked me this a week or two ago, the stats were saying 3%. I think now that's gone up a significant amount. So to the last debt crisis we saw, their ex-date equivalent was on August 2nd, and they came to agreement July 31st. Now, that caused catastrophic impacts on financial markets, and borrowing costs went up and all this different US credit rating decreased. That was quite a significant event. And we're already starting to see some of those negative effects, and we haven't even gotten, we're getting very close, but we're still about a week away from the ex-date. So I think it's going to be quite a big week and a lot of volatility. And I think given that their sides are still very far apart, which basically every politician has said they're nowhere close to a deal, the chances are a lot higher than that 3% 2 weeks ago. So, I mean, it's hard to put a percentage number on it, but especially given the current economic climate at the moment and the potential incompetence of people behind the scenes, it is a lot higher than previous kind of debt ceiling crises. So, and as we discussed last week as well, we saw the CEO of JP Morgan was already preparing for this. He was having regular meetings. So I think it's time for people to prepare. And I think the big update is the markets are starting to respond and stocks are starting to go down. So maybe we have a potential panic situation that is coming into play here.
And I guess, the problem with that is if people start to panic, it's like a snowball effect as well. So look, quite possibly, if we go on a previous record, probably most likely, come to a deal at the very last second, at the very end of it. But as we were saying last week, even a 3% chance, which has now gone higher than that, even at a 3% chance, you need to prepare just in case. As we always say, and we say in the article, is hope for the best, but prepare for the worst.
Absolutely. That's a great point as well. Every day this goes on, the chance only increases. And I mean, if it's 10% now, that's a 10% chance of like a near Great Depression in the event that an agreement isn't come to. That's crazy. Like, that should be top news, and it is.
Well, a 10% chance of anything with that such high of an impact, if you're not preparing for that, it's hard to know what to say. So, and of course, that's why we've seen, so many people come through the doors here at Ainslie, and also buying the gold, silver standard tokens as well. So I appreciate, as always, you joining us for insights. I'm sure we'll speak to you next week as well. We'd love you to keep us updated with what's going on with the US debt default. And of course, to all the audience out there, we'd love you to head over to ainslieBullion.com.au and also check out goldsilverstandard.com. This has been Insights for Wednesday. As always, balance your wealth in an unbalanced world. Take care, and we'll see you next time.